China's $6 trillion stock market drop. The second largest economy in the world has big issues while US stocks are currently riding all-time highs in China. The story couldn't be more opposite. Chinese stocks have raised more than $6 trillion since the 2021 peak, and the sell-off keeps getting uglier. China is the worst performing major market so far this year, and it's getting so bad that Tokyo has now overtaken Shanghai as Asia's biggest equity market. It's not good news either for the country's local asset management industry, with the meltdown in Chinese shares causing the highest number of mutual fund closures in 5 years. If we take a look at data comparing the CSI 300 index versus the MSCI World Index really since Q2 of 2023, China's biggest companies have suffered an enormous sell-off, and if you want a truly insane statistic, the Hang Seng P ratio is now lower than the Nasdaq's price-to-book ratio. That is mind-blowing. But unfortunately in China's case, when it rains it pours, and there are a few key reasons why it doesn't look like the country will be getting out of the woods anytime soon. The first is huge. Painful deflation continues. Deflationary pressures as a result of an extremely sluggish post-Go recovery. So, unlike the US, China has really struggled to revive its domestic demand for goods and services after tough lockdown measures, and this situation has caused widespread deflation in the Chinese economy. Consumer prices have now marked their longest streak of decline since 2009, with the Consumer Price Index falling 0.3% in December from a year earlier. It was reported in Bloomberg last week that China's economy-wide prices are in their longest decline since 1999. That measure, calculated by Bloomberg using the difference between nominal and real GDP growth, contracted for the third straight quarter in Q4 of 2023. The people simply aren't spending their money, and Chinese businesses are really feeling the pressure. Factory gate pricing, which is the pricing for goods and services quoted by the manufacturer before any taxes, shipping or other fees are added, fell 2.7% in December after a 3% fall in November. These prices have now been on the decline for more than a year, thanks to lower commodity prices and weak demand locally and abroad. In fact, Chinese exports fell 4.6% over 2023, which marks the first annual drop since 2016, a worrying statistic considering just how much of a pillar exports are to the Chinese economy. The value of Chinese exports is also in decline, making them cheaper for foreign consumers. In October, the index of export prices hit the lowest level in data going back to 2006, was only slightly higher in November. Food prices in China have also fallen now for 6 straight months, and all in all, the ongoing deflation everywhere in the economy is leaving economists wondering if any meaningful stimulus from the government will ever arrive. Yes, you heard me right. While most countries around the world are currently keeping rates high to slow down a hot economy, China's situation is the opposite. China's central bank has pledged to step up macroeconomic policy adjustments to support the economy and drive a rebound in prices, but the world is still waiting to see the CCP take meaningful action. The problem that China has is that demand in the economy is chronically weak. That's why prices are so weak as well. They keep talking about the fact that they want to strengthen domestic demand and quote, strengthen consumption, but time after time they fail to take the measures that actually will do that. Raymond Yung, chief economist for Greater China, has said it best, quote, China needs to act boldly to break the deflationary cycle. It will fall into a negative spiral otherwise. And that's the tricky thing about deflation. Like inflation, it can spiral if left unchecked. This is very much what happened in Japan during the 1990s. Price levels decline, which leads to lower production, reduced wages, decreased demand, and continued price declines. So economists are urging the Chinese government to step in and provide some support, and many are expecting this through interest rate cuts. The Chinese government, on the other hand, might have another plan after most analysts expected the People's Bank of China to lower the rate on its one-year policy loans, called the medium-term lending facility, to 2.4%, a 10 basis point reduction, and what would have been the first rate cut since August 2023. The central bank decided to leave interest rates where they were. They chose to do nothing. This left analysts baffled, as there is no doubt deflation is a big concern that needs to be addressed by the Chinese government as soon as possible. Some sort of stimulus will be necessary, and that point is further backed up when you look at their shocking recent economic data. But before we get to that, I'd just like to give a big shout out to the sponsor of today's video, Blinkist. Blinkist is a great resource for those who like to learn but can't devote hours and hours per week to reading books. So I love the blink of that, because you can get an enormous selection of non-fiction books and podcasts summarized into roughly 15-minute audio bites. It's a genius idea, and it really helps you cut down the time investment to learn new things. As I said in a previous video, one of my goals in 2024 is definitely to read more, and thanks to Blinkers, just yesterday I listened to The Blink of Millionaire Success Habits. Took me all of 20 minutes. Personally, I like the productivity entrepreneurship. Thanks very much for watching, guys, and I'll see you all in the next video. Don't forget to subscribe and like.